Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. With everything going on in Ukraine and commodity prices, US interest rates, local employment, it's been very difficult to know quite what to do as an investor. Certainly, markets have been volatile. I wanted to have a look at how we could help out investors this morning and where to find opportunities. AMP Capital Australian Equities Portfolio Manager Dermot Ryan is my guest this morning. Dermot, I've spoken to you quite a bit over different times. I'm sure you can give us a good oil.
Thanks, Sean, and good to be on the show again. Yeah, look, it's been a very, very top-down and volatile market in 2022. We've come off two very strong years. And you're right, geopolitical tensions have really taken the forefront, particularly in Europe, but also risks are building in Asia. More importantly, all these supply chain issues that we've seen over the past 2 years are being exacerbated by this. So we're seeing kind of inflation come through, producer-led inflation coming through, and the central banks are starting to have to come off the sidelines. So we're seeing, we saw the 25 basis point move from the Fed this month, as well as, we think the RBA is going to have to step up and start raising rates as we get later into the year. So there's quite a lot of volatility there. From the stock market point of view, it's not necessarily all related to the earnings and profitability.
Yeah.
And we've seen some really big moves. Some of these tech stocks in particular, just the sniff of interest rate rises, some of them are off 50, 60, 70%. So it's been a wild ride in some corners of the market.
So let's talk about some of that. I want to get on to tech stocks and banks and things like that. But just as an investor, what an overall guiding principle about how I think about investing my money, or at least thinking about my portfolio at the moment, before we get into specific sectors?
I guess from that way of thinking, the last decade has been very low interest rates or falling interest rates in Australia, but very low ones offshore. It's been low levels of inflation, and there's been PE expansions in areas where there has been growth. What we're kind of facing now is a different set of kind of top-down inputs. So inflation looks very persistent and looks likely to be growing. So inflation is running at a high single digits in Europe and the US, and Australia is likely to be increasing from around 4% now up towards those levels as we come out of COVID. So we're expecting kind of wage and input inflation. So you've really got to look at margins when you're in equities, and you also have to look at how inflation may eat some of your returns in areas like fixed income, where your coupons for your bonds are fixed. So they mightn't be as effective at driving returns in your portfolio as we go forward. I think you also need to think about where interest rates go from here and how far up they go, essentially, and try to think about your portfolio in terms of, is it very levered? What areas of your portfolio have a lot of gearing and debt on their balance sheets, or indeed, how do they get impacted as interest rates go upwards? So tech, again, as they've traded without profits for a long time, but the stocks have gone up because money has essentially been free.
Yeah.
But now that your cost inflation is high and the price of money is going up, people are not willing to wait for a couple of years for a company to become profitable. And so they're reducing the amount they're willing to pay for that. So the converse of that is that stocks with good cash flows are actually becoming more valuable. And so that's why we're seeing this big shift towards the value style of investing, which is more fundamentally driven and looks for things like reasonable valuations to history, cash flow, dividends. And so there's been a real shift in the last 3 months to that kind of style. And that's probably likely to continue as we go forward and as interest rates go higher from here.
Okay, I mean, you mentioned tech, and what I thought was interesting last week when the Fed lifted interest rates and set out the time frame for future rate rises, the tech sector actually did really well. And Block, which obviously bought Afterpay and trades here, that was up 10%, I think, on that next 24 hours or so. Is that because of the certainty of rate rises? Is that why tech stocks reacted that way?
In that specific case, I think it's because up until a couple of weeks ago, the Fed was expected to raise interest rates by 50 basis points this month in March, and instead they only did 25. And so what is actually happening there is that the path of rate rises was expected to be steeper. And so basically that's caused somewhat of a reversal of the sell-off in tech and some areas of the bond market. They actually rallied then because the interest rate glide path will be less steep. And that's partially because of all the uncertainty in the world and the fact that, in a way, the cost increases are in effect like an interest rate increase to households
Yeah.
because they reduce disposable income in the same way that rising interest rates might.
Stay with me, Dermot. We'll be back in a minute. My guest this morning is Dermot Ryan, Australian Equities Portfolio Manager at AMP Capital. Okay, what about the banks? They've been remarkably resilient in the past few weeks, and particularly given, well, is that because interest rates are rising and they make more money when rates are rising? Or how do we think about the big banks?
The big banks are a reasonable place to be at the moment. Partially, the profitability has been good, credit conditions are strong. And I guess the banks also, they don't want interest rates to go up too quickly because then, house prices might come off or
Yep.
people will get into some difficulty with their loans. So that kind of Goldilocks rate rise path actually works reasonably well for banks. And so what we're seeing is, the domestic big four banks doing well and dividends have been good. They're back on track there after prudently holding back a bit of capital during COVID, but they're now in good shape. But we're also seeing, the likes of Virgin UK, which is a UK challenger bank listed in Australia, is starting to perform quite well as Genworth, which is, they do basically reinsurance for first home buyers and high LVR for a lot of the banks in Australia. So that stock has done very well over the last 6 months because, again, credit conditions are good and the fear of very rapid rate rises has dissipated somewhat.
It seems among the miners, it all just comes down to commodity prices in China, or is that too simple a concept?
Well, of course, miners, the revenue and profit line is a lot about commodity prices and the health of things. Chinese growth is moderating, though, and there are some worrying signs in their property market. But they've come out in the last week and said that they're going to try and stabilize growth and hope to attain a 5.5% growth rate this year. And so what we're seeing is iron ore prices have been very strong and are certainly pointing to very large margins for producers there. But we're also seeing good commodity prices across nickel, copper, and all the energy sector exposures as well, like even coal.
Yeah, okay. I never quite know how to think about Coles and Woolworths, those consumer staples, those big companies, which every time I read something that says buy, the next thing says sell.
Mm-hmm.
How do we think about those sorts of organisations?
Well, these sorts of organizations they've been COVID winners, I suppose, as people haven't been able to eat out as much as they would have liked perhaps over the last 2 years. But margins have been under pressure because costs have picked up and they're trying to get into new areas such as home and online deliveries. And so there's a lot of spending going on their kind of, their own infrastructure and logistics capabilities. So margins haven't been as good there. However, they are spending now, so they're set up for the future. And so, we think it's probably a little bit of a bumpy ride for the supermarkets in the short term. But longer term, they're in a pretty good position to be able to kind of defend their position in the market. We probably prefer some of the more discretionary retailers at the moment because a lot of them are net cash. They don't have to do that spend. And we think there'll be more off-market buybacks, the likes of which we saw from JB Hi-Fi in February.
So those consumer discretionaries are the JB Hi-Fis of the world, that style of company.
Yeah, Harvey Norman, Adair's is another one. We like that one. We've stepped into recently because it's half online play.
Yep.
So, it's kind of gotten wrapped up into that tech sell-off. But, it's also half a bricks and mortar retailer. So the stock has sold off, I think, over 50%. So we just thought that's not a bad position to be in. And if there is any other lockdowns or issues, it's kind of got both sides of the market covered. So we thought that was an interesting one for the portfolio.
Any others for the portfolio, that you're thinking about?
Well, we're really trying to think about how do you manage inflation. Reporting season was good and margins were actually quite strong. But what was notable was only 50% of stocks gave guidance.
Yeah.
And so it's a tricky outlook out there because there's a lot of things happening. But I think there's a kind of some areas of relative certainty. We really liked energy space. So that's been a space we have been long and it's done well. We've been adding to Horizon, which is a coal haulier.
Yep.
They've got very good inflation pass-through. It's essentially a regulated rail network and they run the locomotives as well. And they're also getting into grain on the west coast. And grain has been one of those areas that has done well in Australia because we've had favourable weather for growing. and also because of the disruptions in Ukraine, which is a major grain exporter.
Yeah.
And there's quite a good opportunity there. And I think similarly in the energy space, these geopolitics and rising commodity areas really benefit a commodity exporter like Australia. And that's one of the reasons why Aussie equities have been outperforming this year relative to other major global indices.
Dermot, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Dermot Ryan, Australian Equities Portfolio Manager at AMP Capital. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.